Why trading a 2-to-1 reward-to-risk ratio is a terrible idea. You know, for the longest time, I used to believe in that classic trading rule. The 2-to-1 reward-to-risk ratio. I mean, it's everywhere, right? Every beginner guide, every trading course, they all tell you to aim for $2 profit for every $1 you risk. On the surface, it sounds logical. It seems like a smart way to trade, a way to keep the odds in your favor. But let me tell you why I think this whole 2-to-1 ratio thing is overrated, and honestly, a terrible idea if you stick to it rigidly. First, let's break it down. The reward-to-risk ratio is pretty simple to calculate. You're comparing the amount you're willing to lose on a trade to how much you hope to gain. So, for a 2-to-1 ratio, if you're risking $50, you're aiming to make $100. Sounds good, right? But the problem is, this idea has been drilled into traders' minds as some kind of golden rule when it's really just oversimplified. Think about it. The 2-to-1 ratio assumes that every trade operates in the same conditions, with the same level of predictability. But the markets are wild. They're volatile. You've got different trading styles to consider: scalping, swing trading, long-term investing, and none of them behave the same way. Yet, people act like this ratio is universal. It's not. Here's where things get tricky. The ratio ignores your win rate. If you have a low win rate, even a 2-to-1 ratio won't save you. For example, imagine you're only winning 30% of your trades. That means 70% of your trades are losses. Even with a 2-to-1 reward to risk, you'd still be losing money overall. Successful trading is all about balance, finding the sweet spot between win rate and risk reward. Focusing on just one side of the equation is like trying to bake a cake with only sugar. You need the whole recipe to make it work. And let's talk about market volatility for a second. The market doesn't care about your 2-to-1 ratio. If you're trading in high volatility conditions, like during an earnings announcement or after some major economic news, price movements can be so extreme that your carefully planned ratio goes out the window. You might get stopped out before your target is even in sight. What's worse is how this obsession with the 2-to-1 ratio creates a false sense of security. I've seen so many traders think, if I just stick to this rule, I'll be fine. But trading isn't about playing it safe. It's about being smart and prepared for the unexpected. That's why rigid rules like this can sometimes hurt more than help. They make you overconfident, and that overconfidence leads to sloppy decisions. Now, let me share what I've learned instead of relying on the 2-to-1 ratio. First, it's crucial to adapt your strategy to the market. Some days, the market is trending, and a 3-to-1 ratio might work great. Other days, when things are choppy, even a 1-to-1 ratio could be the best option. Flexibility is everything. You can't treat trading like a one-size-fits-all game. And here's another game changer: balancing your reward-to-risk ratio with your win rate. If you're winning a lot of your trades, you might not need a 2-to-1 ratio at all. For example, a day trader with a 70% win rate can be profitable even with a 1.5:1 ratio. On the other hand, if you only win 40% of your trades, you might need a higher ratio, like 3-to-1, to make up for the losses. I also want to mention something a lot of people overlook: position sizing and diversification. These are your real safety nets. By spreading your risk across multiple trades and keeping your position sizes manageable, you can survive even if 1 or 2 trades go south. Think of it like this: you wouldn't put all your eggs in one basket, right? It's the same idea here. Let me give you a few examples to illustrate why the 2-to-1 ratio isn't always practical. Take high volatility markets. When prices swing wildly, your stop loss might get hit before the market even has a chance to reach your profit target. Or consider scalping, those quick, in and out trades. For scalpers, a 2-to-1 ratio just isn't realistic because they're working with such small price movements. And then there are long-term investors. They're looking at dividends, compound growth, and market cycles, not rigid reward-to-risk ratios. So, here's the bottom line. The 2-to-1 reward to risk ratio might work for some traders in certain situations, but it's not the holy grail it's made out to be. If you stick to it blindly, you're setting yourself up for frustration and, worse, potential losses. The key is to approach trading holistically. Focus on the bigger picture. Look at your win rate, your strategy, the market conditions, and how much risk you're really comfortable with. Trading isn't about following a formula. It's about thinking on your feet, adapting, and staying sharp. So, forget the 2-to-1 myth. Build a strategy that works for you, and don't be afraid to break the rules when the situation calls for it. Thanks for watching.